Good morning and welcome to today's edition of the London Session Open. My name is Alejandro Zambrano, Chief Market Analyst with TradeCaptain.com, and we should be live on the page right now. Sorry to keep you guys waiting. So we're going to take a look at the markets as we usually do at this time of the day, and I'm going to begin with the Euro versus the USD. So the Euro itself is quite boring right now, but I think it could be a great opportunity to trade in the next few weeks. Could potentially be something really powerful. Uh, Major reason for that is just that the market overall is just trading sideways between 121.55 and 125.22. But this has narrowed quite a bit, so I think we should very soon, if not already today, sort of get really busy on break to the upside here. So if things trade about 124.80 is quite likely. I think it's just going to try to push higher and maybe try to get all the stops on the upside here, and could potentially be the resumption of this multi-month trend that could potentially take the euro up to maybe something like 128. You can see here that if we take out this high, the market could potentially go up to the next high, which is 128.82. All right, so that looks really interesting. On the other hand, if say the market trades below support, uh, the market could decline to 119.16, and maybe this is a major high will be at that point. So probably down and up, and then eventually maybe down to something like 115.59 on a break to the lows. Obviously, we're not there just yet, but very interesting. Um, Gold as well is a market that I found really interesting for the long term, as I highlighted many times before. If we take out the highs, it could potentially be the start of multi-month, multi-weeks, probably, maybe multi-year run as well, or multi-month run as well, but potentially 11% return here. And 11% is interesting by itself, but if you buy 2 times, maybe 3 times on the way up, then an 11.3% move could be the only move you need for a year. So I'm finding both the euro and the price of gold very interesting. In the short term, however, the market is not really that interesting. The market trend is bullish, but it's a very fragile move, and the market could go to the upside, same way as it did here a few days ago. We said probably it's gonna push up, which it did, but it's a very fragile market. I'm not sure it will go up. Technically, though, it's bullish above 122.36, which I've been mentioning over the last few days. If we take this level out, probably gonna go down and then probably up again. I don't think we're just gonna break low and head lower. It doesn't make any sense. Um, if anything, you have the non-farm payrolls, so maybe it's gonna trick the market in a way that it goes down and then quickly bounces to the upside. Here's the price of the pound versus the USD. Here overall, we're dealing with a healthy uptrend. The pound is doing quite well against many different currencies, uh, up, but obviously capped. It's a little bit a situation like this one here. The market had that decline, then it had a rally, and then it had that correction. And I think we're in that sort of situation right now. And this market could continue to move a little bit lower, but if this overall bullish trend is, if it's going to continue to be bullish, then we shouldn't really trade much lower than 138.86. So any scalping traders or any short-term traders, I think most traders, they're happy to put stop losses here. If this doesn't hold, it's probably going to continue to trade lower, and then maybe at lower levels, traders might look to buy again. So they save about 100 pip on that move. Uh, So again, no real change to what I said yesterday. Here's the dollar yen, and we're talking about a bullish market. The market moves back up to the sell zone and could or should really potentially roll over here and move down. Technically, the trend, is bearish, so I want to maintain that bearish bias. Um, Obviously, things are changing. Something I discovered yesterday by looking at the markets is that stock markets are starting to look really healthy. Um, S&P, let me just show you what that looks like, moved down and on the day and overnight. So it moved down and started trading down here at 10 a.m. London time, and then had a very powerful move to the upside. And that is potentially it. Like this could have been the low, and the market probably up, maybe squeeze itself up a bit and then down and then up. And it's not just that market, it's several markets. You have the Japanese stock market as well, which to me, if you look at it from 4 hour, has definitely changed, hasn't has changed slightly its characteristics. Again, um, up, down, up, and then trading sideways. And then you had that little break here, and it's a little bit trickier here, but potentially could be enough just to work with a stop down here. But I have a feeling that we are having more of a risk on situation, and then maybe something like that. It's not just that market. This is the Chinese stock market. Well, not the overall stock market, but one index is called the China A50. And again, the market is looking to bottom out here potentially after, trying to trade lower. And that has spilled over into things I'm already holding, like the Australian dollar yen, which is very bullish and almost took us out. Surprised it didn't. But then it's where you have things like the pound yen, which I found really interesting as well, where it can take out 150.89. I think if we take that level out, up, down, and up. So I think that's sort of the theme, which is again, market starting to stabilize stock markets and pound yen potentially looking to move to the upside, dollar yen as well. You already have the CAD yen, which gained quite a bit already. So this is the CAD yen. The market took out its high here, but the sort of bullish momentum started 3 days ago. So I think that we're leaning in quotes more of what we call a risk on situation. We've also seen this spill over into all CAD to some extent. Here's the Aussie dollar, sorry, yes, Aussie dollar versus the USD. Technically, the trend is bearish here, but it below these highs, and there's no real change. Obviously, the market's moving up a bit, it's stabilizing, but here there's no real change. And technically, again, there's no real change in the dollar yen either, right? It's just that it starts to look to me that the market could potentially look to bottom out. And here's the New Zealand dollar versus the USD. The market did try to break to the upside at a very, very late stage yesterday, but it didn't really manage to do that. So I wouldn't be buying there unless you're like super very convinced. I think the issue with the New Zealand dollar right now is obviously that it's trending sideways, and it's just a Thursday. You have the non-farm payrolls tomorrow, and I suspect that if we trade above the high here, the market could head to the upside. So I'm back into neutral. Um, I know it traded above there, but it traded very late. You need to be really convinced for buying. If you're still holding on to how long, then stops goes down here. Here's the dollar CAD, and the Canadian dollar has seen its price gaining over the last few days. The market took out support, moved down, and then it moved up. was a correction. Fibonacci, we corrected almost 50% of the move, and then the market moved to the downside. I think here on just a short term, it's obviously bearish, could easily go up to 128.28, and then, but eventually I think it's going to go down. It looks to me, this is a month that took, sorry, formation, sort of a high that took more than a month to form, more or less. We reached this on the 3rd of March. It's now the 5th of April. So, yeah, sorry, 5th of April, 5th of March, and this is today's 5th of April. So it took more or less a month. And the market here, I think, probably up and then down. But this could potentially be something we can maintain or hold all the way down to 124.51. And again, it's sort of on the theme, risk on sort of theme. Here's crude oil. Actually, sorry, I need to save this chart. Here's crude oil. The idea was for the market to bottom out here. It closed well and closed around these highs, which is great. Could easily go down to 62.70, but again, it's sort of bouncing from those we wanted to bounce. The market as well was oversold around these levels, which makes perfect sense. And hopefully the market is just gonna move down a little bit, but eventually up. There's no real change here to this trend. This, as well as the market, an overall market is bullish. Here's gold. Gold is under pressure today, moving down a bit. I guess with rising stock markets, people don't see the need to hedge with gold. Technically, nothing has really changed. I think shares still might buy at 1,316. Stops goes below 1,302. And this is the S&P. S&P is looking really interesting. And I am considering either to buy a pound yen or buy a stock market like the S&P. We took out this high, and I think this could be the beginning of sort of probably up, down, and up, with probably price now trading below these lows again. So fib like that, and hopefully we have a bit of a correction like this, and then the market just hits higher like that. And I think it makes sense just to be bullish above this level here. Like that. This is the Nasdaq, very close to taking out the trend defining level. I'm not 100% sure if stock wants to bottom out, but it do start to look like it. And here's the DAX 30. DAX 30 moved down, almost touched the target, but it's now back up to the highs. Technically, there's no real reason to change the bias. The market remains bearish at these levels, and should really roll over. But here again is sort of a sign of strength, really. That the market here is, moved all the way down and then all the way up. I mean, that's a clear sign. As well, it closed at a higher level, which is usually a sign of bullish. And those are the markets. I remain short. The dollar CAD stop is still up here at 129.55. Still short the Australian dollar versus the Japanese yen. I have, however, been scaling out a bit as this market had not moved to my advantage. So what I did is that I closed down a little bit here, open up a little bit extra on the dollar CAD. So trying just shifting out the position from one versus the other one because this hasn't really been going my direction. I have a strong feeling that we will be stopped out here. Now, As for another position, I'm considering again to buy maybe the Japanese stock market. I do have does look to me that we potentially bottomed out. The only issue with this though is that it requires such a wide stop loss, potentially down at 20,539, which I don't like, because of this, we have stop of 5, almost 6%, and then yes, for rally you can get 10, but most likely it's just going to be this section here, which means that we could potentially make 4%. So not really the best. Then I was looking at this Chinese stock market index as well. It does look to me, because the 200-day moving, you can't see it, but the 200-day moving average is about here. And again, this could be potentially good, because if it actually bottoms out here, so we have a little correction, then the risk is 2.5, maybe goes up here 7.66, and if it goes up here it's 10. So then that's a better risk reward ratio. So it's not all clear. This is another one that makes sense to be watching, and it's the pound yen. I like it because the overall structure is bullish, so take out the high, and then we can do as we do here. So let's keep an eye on these markets. I think sort of the next theme, or the theme that is building right now, is risk on. Okay, let's just save these charts, and then we'll see if we can answer some questions. Another little thing which is really interesting is that because of these market volatility and market decline, now you're starting to see, much more on TV on, how the situation is bad in um, with the stock markets and world economy, trade wars. I mean, everybody knows about trade wars now. But what's also interesting is that I have friends that obviously work within the um, industry, forex industry, and they created some banners yesterday for, I think it was the French market, which talks about, the stock markets, things being depressed, and trade wars. And it's these guys are marketing people, those guys I'm talking about here specifically. And so they obviously follow the news, but there's always a lag between when you see a news and then when you actually, you know, do a banner about it or advertising around it. And the fact that they launched those events yesterday um, is telling me that, maybe this is it. You know, something slow moving like uh, a marketing campaign usually comes at the end of a move. And what's interesting, of course, is that, again, we're seeing sort of the market looking to bottom out. Okay, let's see. Do we have any questions here? Why is the New Zealand dollar holding up so well? Any good? Okay, any guess on the NFP? I haven't been following the macroeconomics of New Zealand that much lately, so I wouldn't be able to tell you that exactly. But I do know that, flow related, you have the Australian dollar versus the New Zealand dollar. And here's something I've been bearish, and we had a break to the downside here. So it had a strong decline here, or relatively strong decline. A break here in February, the market is down with 2.75%. And the reason which is guiding at least this pair lower is that dairy prices have been holding up well, while iron ore prices have softened. So that's caused traders to prefer selling the Australian dollar. I think in general, iron ore prices have been softer. So let me see, this is iron ore prices. And you can see here that they were trading at 71.79 dollars, I think, a ton. And it's now at 62.94. So we had this decline here. So this is one explanation. I haven't followed up on all the macroeconomics, but I know that the people have been much more keen on selling the Australian dollar over the New Zealand dollar. As well, everybody knows that Australia is closely linked to um, China when it comes down to their export of iron ore and other sort of resources that the Chinese use. So people's favorite play or preferred play has been, sell the Australian dollar over the New Zealand dollar. So that could be something that could influence. Now, I haven't actually looked at the economics of New Zealand, but we can take a look at it. We do have some time. See if I can find this here. It's not even on the list here. The reason why they sort of stopped following economics and doing like a lot of analysis is just because sort of macro fundamentals out the window, really. The traditional drivers like interest rates just don't work and haven't been working so good lately. Here's the GDP rate, and this is the quarterly GDP rate, so at 0.6. Here's the annual. That's the quarterly again. Let me see if it was an annual. Can't find it right now, but growth okay-ish. Unemployment rate, definitely trending lower, 4.5. 9-year low, that's a sign of tightness in the market. Now the unemployment rate has been, around 4%, 3% looks like here. So we're heading towards those very, very low levels, which is good sign of strength. Inflation rate picked up in January and still around 1.6%. If I remember correctly, the whole idea of the Central Bank of New Zealand was that inflation was temporary. At least that was the theme in the beginning of last year. But obviously, inflation is quite healthy. At 1.6, though, it's not really that alarming. Here's core inflation. In core inflation is the 1.6 as well. So again, some solid numbers here. Um, Points to some tightness with the unemployment rate as well. Now, this is the number of unemployed persons in New Zealand. This is the actual just number of unemployed people. And here, it doesn't look that good uh, from this perspective. Actually, sorry, let's not work with this one. This data is just up to 2016, so let's not work with that. Here's hourly wages. because this is just a free sort of website, it just shows you the actual level. I need to have wage growth. So it doesn't actually tell me too much. Labor costs, maybe. No. Hmm. So I can't find wage growth right now, right here. I don't think it's too strong though. Let's take a look at Australia then. And let's just shut this down. GDP growth rate, unemployment rate, inflation rate. This is the annual GDP rate. That should be what we're looking for as well. Unemployment rate, we already have that. Employed people. Labor costs. Here's wage growth. And we need core consumer price index. Core inflation rate. So this is core inflation rate. Core inflation rate here is 1.18. Core inflation rate in Australia was at 1.6. Also, New Zealand was 1.6. So this is a solid reading. Here's the GDP growth rate at 0.4. It's a little bit like New Zealand, not too strong. Here's the unemployment rate. The unemployment rate is a good indicator, again, to underlying pressures. And here you can see how the unemployment rate in New Zealand or Australia reached 5.4, but it's not trending lower. It's trending upwards, so we're having a bit of a softness here in the labor market. And usually when the unemployment rate starts to tick up higher, like this, then the central bank starts to become less interested to raise interest rates. I think from a historical level as well, again, we're about, this is 5%, but the unemployment rate has been at low levels. So when the economy is really, really good, it's been done at 4. And at the same time, we remember New Zealand unemployment rate, it isn't that far away. So this is about 1 full percentage point away from 1.5 from sort of the sweet spot of 4%, whereas the New Zealand unemployment rate was at 4.5 and could potentially go down to 4, and that will be that sweet spot. So you have that tightness in the labor market in New Zealand that is much more tighter than Australia. Inflation rate is about 2%, and pretty much like New Zealand. Here's the annual GDP growth rate, 2.4, which is okay. This is just the GDP growth rate multiplied by 4. Um, labor costs, annual change in hourly pay rate. Now this is a solid, nice level actually, 2.21. So obviously, if the unemployment rate wasn't, um, because the unemployment rate, even if it's quite far away from its target, you still have a solid 2.1% wage growth year on year, which is interesting because in the US is at, well, 2.7. Now, I don't know the numbers from New Zealand because I can't get hold of them here, but uh, this number here tells us um, that maybe we don't have to go down to 4% to sort of hit full employment, because the 4% unemployment rate in Australia was in a situation when the world economy was doing really, really good, and say the Chinese needed a lot of resources, a lot of iron ore, to give you an idea, right? But obviously, the Chinese economy is not building all these cities as it used to do. And so the need for, you know, the actual economy in Australia has probably changed since then. There's probably less people working in mining, and a lot of people doing new things that didn't maybe necessarily exist in 2008. But let's look here. See if I can find some information on this. Okay, so there is actually one. It only gives us the numbers here. I guess we could use the calculator to manually figure out what this is. Yeah. So what I did, I just took 11,058 divided by what looks to be the January level of last year of 1137, and that gives us a wage growth of 1.8. The wage growth in Australia was slightly better, but I guess they're a little bit comparable. So I guess that could be a bit of an explanation. The sort of next layer right now, when you have done and looked at all these data, would be to just read the last statement from the Central Bank of New Zealand and the last statement from the Central Bank of Australia. And then you can see sort of the tone of the market of the central banks and how they are interpreting the data. And I think that would be enough to sort of have a rough idea, really, what's going on. And we just need to read up on that. But if I'm guessing, I would guess that maybe the New Zealand Central Bank is going to be slightly more optimistic on the economy, whereas the Australian Central Bank, because they're probably still focusing on the unemployment rate, will be less optimistic. And then again, this probably should give the New Zealand dollar sort of more of a neutral bias. And in the case of Australia, a slightly bearish bias just because the central bank probably again is focusing on the negatives, I would guess. And then people talk about the whole situation linked with China. So that could be one way of using all this information, and that could potentially explain sort of why the Australian dollar is underperforming versus the New Zealand dollar. In the case of the New Zealand or the non-farm payrolls on Friday, I think the numbers are probably going to be good, and that could potentially lead to a stronger dollar. But technically, we don't have sort of the blessing to trade that yet. Maybe we could potentially trade that against the dollar, but it looks to me right now, especially if you look at the indices, that it's difficult to say if the dollar should be up or down. This is the DXY index, and it's sort of just trading sideways. So it's hard to say what's going to happen. Should we be bullish? Should we be bearish? If you look at the fundamentals, they all point towards higher interest rates in the US. And they already have higher interest in the US. Most likely, the non-farm payrolls are going to be okay. And that should most likely just cause the expectations of higher interest rates to remain strong. And this should all have caused the dollar to gain quite a bit, but it hasn't. And again, I think the reason why that has not happened is because what we call the inverted yield curve, which just means that interest rates in the short term, say, 3 months up to 2 years, are high and they have risen sharply. But interest rates in the long run in the US, like the US 10-year government bond yield, hasn't risen as fast as the short term. And the long term, so they say 10-year government bond yield, um, the interest rate on that is around, I think, 2 point something, 2.81. Now, this is sort of the average. This should symbolize to some extent the average interest rate for the next 10 years. Okay, because this is the annual rate, 2.81. If you buy a US 10 government bond yield today, you get 2.81% for the next 10 years. Now, the way the idea is here is that people that are much more clever than I am, they can speculate with short-term interest rates, hedge off risks with long-term, and vice versa, and that sort of keeps some sort of balance between short-term yields and long-term yields. But the inverted yield curve is telling us that this whole move higher in interest rates in the US is of short-term in nature. It could be because, again, inflation or short-term strong growth. That could be something. And what it's telling us that, yeah, okay, they're gonna raise interest rates at the Fed, but they're not gonna be at high levels for a long period of time. They will eventually go down. The alternative is that the market says, okay, you raise interest rates. You know, I think people are probably even long betting on higher interest in the short term, but they also think that in the long run, maybe this is going to cause a strong economic, uh, uh, very low growth in the US. So the way this into place right now, it is telling us this whole race in interest rates is short term in nature, and that's why people aren't necessarily buying the dollar, or that it's highlighting a recession coming. And that again is one reason not to buy the dollars. And if you look at this variables, it has very nice correlation with the euro dollar right now. And when you look at the how the yield curve looks in Europe versus the yield curve in the US. Okay, all right, guys, we're gonna wrap things up. Uh, about these long-term sort of ideas, it's a bit tricky, to be honest, to tell you exactly how that's gonna play out. But I can tell you the following. Let's just stick with the trends and just follow the trends. And sometimes it makes sense, sort of a bounce in the stock market, uh, you know, correlations to Japanese yen and things like that, you know, does definitely help. And what we're just doing here is just waiting, at least I am, waiting for sort of a nice big move. And I think something is happening with the stock markets. And obviously, if I would read the news on CNBC, I wouldn't be buying stocks or buying the dollar yen. I would just be selling it. But I'd rather trust the charts than the news. Okay, guys, thanks so much for joining me, and I hope all of this makes sense. Again, if you want to know more here, Damien, about the situation between Australia and New Zealand, go and we cover all the basics, so you know a little bit about the unemployment rate, how it's slightly better level in New Zealand. I would probably Google a bit and see if you can find about wage growth, and then just read the last statement from the central banks of Australia and then the other one from New Zealand. And that gives you a very nice, should give you, the missing pieces of the puzzle. Okay, have a good day, guys, and see you guys tomorrow. Thanks.